let's talk more about this tug of war between stocks and bonds with Paul Ashworth from Cameron Harrison. Paul, good morning.
Hello,
Interesting.
Danielle.
Stocks versus bonds. Yes, I will just let you into a little thing because we interview so many people, and one of my bond guys has been run off his feet. He said in the last couple of weeks, everybody wants to see him. Everybody wants to put their money in there at the moment. So with that in mind, what's happening with the mix, the traditional 60-40? Maybe you can run through,
Sure.
where it's been, where it might
Yeah,
go.
yeah. I think a little bit of history is helpful. COVID, is obviously a massive disruption to all things financial and world and society, and that's certainly the case. In terms of structuring of bond portfolios, because up until that COVID period, we had typically, and you've got the graph up there, typically that 60-40 portfolio, was a little bit like a Goldilocks, portfolio. If equities and stocks did poorly, then bonds would step in, to the rescue, and largely insulate returns. And that's certainly been, let's say from the 2000s, all the way through, a few ups and downs, but broadly, we've had that negative correlation, if you like, that offsetting benefit. Prior to 2000, from the 1970s through to, the late 1990s, that wasn't the case. We had more of a positive correlation. So it's a long time ago since, we had that type of negative correlate, that positive correlation. We'd be going back to the very early 1970s to get a similar type of outcome that we got, let's say a bit over 12 months ago, where both stocks and bonds went down in tandem. So that's got everyone questioning, and rightly so. We've had stocks over the last 8 months, and an 80% exposure to stocks or greater, has certainly been fantastic. That's what your graph earlier shows. So, and then it raises the question: well, what is the way forward? Should we be more heavily weighted to stocks, or as you said, are people starting to say, well, that might have actually run too hard? From our perspective, the answer to the question is: do you think we're going to go back to more that low growth, low rate environment that we had pre-COVID? And is that 60-40 balanced portfolio structure, as a mid-risk position for investors, will that reassert itself?
Yeah.
We think it.
Sorry, go on.
The simple answer is, Danielle, we think it will.
Right. So I thought it was prescient to pull up that real bond yields chart, because it does frame somewhat of the argument that you're making. They are extraordinarily high at the moment.
Yeah, look, we're three sigma, three standard deviations out. So, we do like, and we have been, tilting in terms of our interest-bearing exposure, and that has tilted more away from credit and floating rate, and more to fixed rate and duration, because it's allowed us, for the type of returns that we're trying to achieve. We've been able to significantly increase in terms of the quality, going further up the credit stack. For AAA rated paper, that's yielding 6.5%, on a risk adjusted basis. Together with the fact, if you do think we're going back to a lower economic growth, lower interest rate environment, they represent good value. By the same token, we don't think it's the death knell of equities either. We are, in terms of that 60-40 split, we're modestly pro-cyclical, in terms of our settings. We do happen to think, however, that the sell-off in bonds, as you said, in terms of those real rates, has been overdone, and is not properly taking account of where things are going over the course of the next 2 years. And we're still caught up in the noise and data from 1 week to the next week, when we really are starting to see, in terms of those lag effects, really the worm is turning. We're seeing it in terms of lower wages outcomes. Job search data out of the US is turned negative. We see that the US government's growth in spending will be coming off over the next few months, and we're seeing monetary policy. Traditionally, it is only about now or over the course of the next 3 months that we'll see the impact of that significant increase. So, we think it does set. We think the environment is one where growth does go lower and interest rates do go lower, and therefore, we do think that the 60-40 on balance is appropriate as a mid-asset allocation.
Paul, there's a lot of noise, as you said, and a lot of moving parts everywhere at the moment, which I think is really causing, as you said, noise everywhere. If we look at the, someone was discussing the equity risk premium on the US market, which is very low at the moment. Now, post, I think it was either post the dot-com bubble or the GFC, that equity risk premium expanded and it's come right down again. But the point they were making, that it wasn't too dissimilar to what was experienced in the 80s and the 90s. Do you have any thoughts around, the valuations on equities at the moment of such a measure?
When we look at equities, particularly in the US, we're very minded that we're talking about a very large economy, and we're talking in terms of, if you like, sectorisation and market capitalisation, sectorisation of that market. Certainly the bigger names are very dominant in terms of the Nifty 7, the Amazons, the Microsofts, the Alphabets, and so forth. Once we drill down to businesses in the let's say the 20 to 30 billion market cap range, and to give it a local context, a business the size of Myers, of the Coles Group. If we think of a company like that, very big here, probably a bit on the expensive side, but we look at businesses in the US, Pulte Group, similar type, house builder, similar type of market cap. Their valuations are very attractive. They're trading with reasonably high equity risk premiums. They're largely debt free, and they're in the single digits. So we're just very careful when we're looking at the US economy and US equity investment, that it's not one market. And there are very significant parts of it that actually represent good value. One thing that I would say, which is interesting, I suppose a little bit more on a forward-looking basis, Danielle, is when we start looking, we were looking at this earlier in the week, is the implied VIX volatility index for the US equity market. That is very sharply up on an implied forward basis. So it's at very low levels trading at the moment, but the implied volatility is somewhat higher, and I think that is something that those that let's say are overweight and have enjoyed that larger exposure to equities over the last 6 to 10 months perhaps ought to be mindful of going forward.
That's really interesting. So the implied volatility, does it give a time frame on that one, Paul?
It's pretty. It's over the course of the next 3 to 6 months.
Oh, interesting. Oh, okay. I like the point you alluded to about really it being stock picking, a stock picker's market at the moment, because great examples of where there are valuations that could arguably be stretched. But as you say, there's huge chunks of the US market and arguably parts of our market that don't look stretched on a valuation. Do you think it has been a stock picker's market for the last, few months? We wasn't a buy the index well, it has been
Yeah,
a buy the index, but do you think it's going to be more so going forward for the next few months, that stock picking really will be the key to capturing performance? Obviously, good stock, stock picking that
sure.
goes right.
Yeah. Well, and I think with appropriate rules.
Yeah.
So, yes, if we look at, and we're significant investors in the US equity market. But as I said, when we look at that, the where business is done day to day in the US economy, and realise, that they're operating, 4 or 5 very, very big regional economies.
Mm, mm.
Um, so when you look at stock picking, what might be right down south, and that regional economy might not necessarily be true, in terms of the East Coast economy. And within that, applying what type of the various rules as equity managers you might, um, uh, there is a dearth of choice.
Mm.
Um, uh, and we invite people that are looking for quality equity exposures, for quality of managements, just to, again, it goes to the noise, just to put aside the noise and realise that there are some very big, substantial businesses that sit in their mid-cap market, which are 20, 30, 40 billion market cap enterprises.
Yeah.
Um, and they don't pick up the headlines here, and often they don't pick up the headlines over there. But yes, I think it does allow people to discreetly look at excellent managements with appropriate rules, um, and methodology to prosper very well. Without investing in any of those uh, uh, nifty stocks. Our performance to 30 June was 4.5% over benchmark.
Oh, excellent.
So you can get better. There are better risk-adjusted returns. So yes, we would invite people to just to be a little bit more discerning, and look at the breadth
Yeah.
of what's actually offered there, and valuations are reasonably attractive.